They always tell you the same story before it all breaks. The economy is strong. Markets are resilient. Stay the course. You hear that on television while your grocery bill's punching you in the stomach and your rent feels like a second car payment. Deep down, you feel something is off, but every expert in a suit says you are overreacting. So here is the real question behind this video. What always happens before a financial crisis? Not sometimes. Always. Before we go any deeper, remember this is not financial advice. This video is for education and entertainment. Every investment carries risk, nothing is guaranteed, and you should always do your own research before making decisions. So why talk about this now? Because every time we have had a brutal downturn, from Tulip mania to the Great Depression to Black Monday, to the 2008 housing collapse, the same 4 ingredients have been simmering in the background. Different technology, different headlines, different assets, same recipe. And right now, some of those ingredients are starting to show up again. You can feel the pressure in your own life. Maybe your credit card balance crept up last year, then a little more this year. Maybe your car payment and insurance jumped, but your income did not. Maybe you are paying late once in a while and telling yourself you will catch up next month. That is not just your kitchen table problem. That tight feeling has a name. It is what happens when the machine pushes the system too far. So who is the machine? It is the central banks that flood the economy with cheap money, then yank it away. It is the big banks and giant funds that package your debts and trade them like poker chips. It is the politicians who love easy booms and hate hard truths. It is the media that tells you everything is fine, right up until the moment they switch to no one could have seen this coming. Here is their playbook in plain language. They make money cheap. Everyone borrows. Prices of houses, stocks, and everything else fly higher. They cheer on the boom, collect their fees, and hand out bonuses. Then, when the bill shows up, the same people who lit the fire step back and act shocked while you watch your savings melt. But if you look closely, there are always 4 patterns that show up before things break. To see them clearly, we start in a place that seems almost silly now. Tulips, 17th century Netherlands. The Dutch are the rising power of the world. Brand new stock market. Trade ships everywhere. Money flowing in. It is their golden age. And somewhere in that boom, a flower becomes a status symbol. Tulips. At first, it is just rich merchants paying roughly a month's salary for a pound of bulbs. That would be like spending a few $1,000s on flowers today. Ridiculous, but still normal rich people nonsense. Then the first pattern shows up. Rampant speculation and investor overconfidence. Prices rise and people stop buying tulips for beauty and start buying them for profit. They invent a futures market so you can trade paper contracts instead of touching a single bulb. At the top, some rare bulbs go for the equivalent of several years of salary. That is like putting house money into flowers. People think they are geniuses. Even if prices drop, I can always grow more bulbs later. They are drunk on hope, ignoring risk, telling themselves stories about why this time is different. When the bubble finally bursts, it does not just hit flower prices. It hits contracts, land, credit, entire fortunes. The pattern is set. Overconfidence is always there before the fall. Fast forward to the roaring 1920s. Radio, cars, skyscrapers, jazz. The stock market becomes the national sport. People open brokerage accounts the way people open trading apps today. A warning shot had already gone off with the panic of 1907, but the lesson fades. This time a second pattern joins the first: regulatory failure. Either the rules are too weak, or they slam down too late and too hard. In 1929, the rules are almost non-existent. New leveraged investment trusts let people borrow heavily to buy stocks. You take investor money, stack debt on top, and place bigger bets than ever before. Gains get turbocharged, so do losses. Those trusts start trading for more than double the value of the stocks they actually own. That would be like buying a fund today for twice as much as all the investments inside it, just because everyone else is lining up. Nobody in power wants to stop it. The president says the business of America is business. The regulators look the other way. The machine is making too much money. When the market finally crashes in 1929, stock prices collapse almost 90% in the years that follow. 1 in 4 workers ends up unemployed. That means on any street you walk down, every fourth home has no paycheck coming in. Savings wiped out, families broken, people lining up for bread. The first pattern is there, overconfidence. The second pattern is there, regulators asleep at the wheel. Now jump to the 1980s. Wall Street is not a dull back office anymore. It is pinstripes, suspenders, and millionaire traders. Here the third ingredient shows up, a new, poorly understood innovation. Computers make it easy to invent complicated financial products. One of them's called portfolio insurance. On the surface, it sounds safe. If markets start to fall, a computer slowly sells small amounts of stock to limit your losses, like a seatbelt for your portfolio. The problem is simple. No one really thinks through what happens when lots of people are strapped into the same seatbelt at the same time. By 1987, tens of billions of dollars are tied into these strategies. At the same time, you have a mania in leveraged buyouts, hostile takeovers, and quick flips. The market is frothy but still standing. Then prices start to slide. Slowly, the computers watch. They start selling, just like they are programmed to do. But when everyone sells together, those tiny trades turn into an avalanche. Prices fall faster, triggers fire, more selling kicks in. At one point, a specialist on the New York Stock Exchange is standing in front of a crowd with hundreds of thousands of shares for sale in a single stock, and no one willing to buy at any price. Black Monday becomes the worst single-day drop in stock market history. Once again, overconfidence, weak rules, and a shiny new innovation nobody really understands line up like dominoes. But the crisis that lives in most people's memory is 2008. This is the one that smashed neighbourhoods, ended retirements, and made a whole generation feel like the game was rigged against them. And it was. This time, the fourth pattern grows to terrifying size: debt. After the dot-com bust, investors are scared of flashy tech names. They want something safe. So the machine gives it to them. Housing, banks create mortgage-backed securities, and complicated products built from thousands of home loans. If one borrower defaults, no big deal. Spread across thousands, the risk seems to disappear. Except it does not. Because the only way to feed this beast is to approve more and more loans. Not to people with rock-solid finances. To anyone who can fog a mirror. Teaser rate mortgages. No income checks. Loans that explode later. From the outside, the story sounds comforting. Home ownership for everyone. From the inside, the real customers are the investors buying these Frankenstein products. The homeowner is just the raw material. Household debt explodes. People buy bigger homes than they can safely afford because the lender says it is fine. Politicians love the boom. The central bank keeps rates low for years, making borrowing painless. Wall Street collects fees on every deal. You can guess what happens next. Housing prices stall, then dip, then fall. And because the entire system is built on that mountain of mortgage debt, it is not just one market that cracks. In September of 2008, a giant investment bank that had survived for more than a century collapses. Credit freezes. Businesses cannot roll their loans. People get laid off. Unemployment jumps. Whole neighbourhoods are left with empty, foreclosed homes that sit like broken teeth on a street. From the outside, it looks like everything broke overnight. From the inside, the patterns were there all along. Overconfident investors flipping houses and bragging about second and third properties. Regulators who let the new mortgage products grow unchecked. Innovations that even the bankers selling them did not fully understand. And a tidal wave of debt that could never be repaid if anything went wrong. So what does all this history actually do for you? It gives you a simple lens, because while you are being told that the economy is resilient, the machine is quietly changing its own behaviour. Big, patient investors are not charging in with both feet. They are holding more cash. They are buying short-term safety with part of their money instead of chasing every new high. That is not the move of people who think everything's cheap and safe. That is the move of people who want dry powder when things go on clearance. Watch what they do, not what they say. So what always happens before a financial crisis? The same 4 questions start flashing, even if nobody on television puts them together. First, overconfidence. Are people speculating, buying just because prices went up yesterday? and hoping to flip to a greater fall tomorrow. Second, rules. Are the referees missing an action while a new market explodes, or are they slamming on the brakes in a clumsy way that shakes the whole stadium? Third, innovation. Is there some new product or platform that everyone is using without really understanding the risk, something the salespeople describe like magic? Fourth, debt. Is there a rising sea of borrowing underneath all of it, in households, in corporations, in governments, that only works as long as nothing shakes the tower? When those four answers lean the wrong way long enough, you do not need a crystal ball. You just need a calendar and some patience. Because it is not a question of if, only when. That sentence is not meant to scare you. It is meant to wake you up. Crashes are not a bug in the system. They are how the machine resets the game. They let overpriced assets fall into stronger hands. They wipe out the over-leveraged and reward whoever had patience and cash on the sidelines. And no, you cannot control when that reset happens, but you can control how prepared you are when it does. Think of it like a hurricane. You cannot stop the storm. But you can decide whether you are the person buying batteries in calm weather or the person in the empty aisle the night before landfall, asking where all the water went. So here is a simple way to think about your role. First, storm prep. Before any crash, your job is to make your own life less fragile. That might mean paying down the kind of debt that explodes when interest rates move higher. It might mean cutting back on the habits that are quietly swallowing your paycheck, the subscriptions you forgot about, the takeout that turned from a treat into a default. It might mean building a small cash cushion, not so you can perfectly time the bottom, but so you are not forced to sell in a panic if you lose a job or take a hit. It also means making a list in calm weather, not a list of what to panic sell. A list of what you actually understand. The businesses, the funds, the assets you have taken the time to study while your head is clear. The ones you would be happy to own for a decade if the stock market shut down. You are not promising yourself that you will buy them on day one of a crash. You are simply deciding, ahead of time, which things are worth considering when everything is on sale. Second, crash action. When the panic finally comes, and at some point it will, your job is not to be the smartest trader in the room. Your job is to be the calmest. Instead of going all in on the first scary headline, you move in layers. Maybe you buy a little when prices are down a bit, a little more when they are down more, always within limits you set before the storm. You focus on time in the market, not perfect timing of the market. Instead of staring at a red screen and refreshing news feeds that are designed to scare you, you go back to your plan. You look at your list. You compare current prices to your own understanding of value, not to yesterday's high. You remember that while crashes feel like the end of the world, history shows they eventually turn into the beginning of the next cycle. Every major downturn we just talked about eventually produced new opportunities, new fortunes, and new chances for people who were prepared, patient, and not over-leveraged. The machine needs you confused and reactive. They need you chasing whatever is hot in the boom and dumping whatever you own in the bust. They need you believing that you are crazy for feeling that something is wrong when your life feels harder, even as they say everything is fine. You are not crazy. The system is. You cannot fix it on your own, but you can stop playing the game on hard mode. You can learn the patterns. You can prepare in calm weather. You can decide that the next time the headlines scream crisis, you will not be the one standing at the edge of the cliff with no savings, no plan, and no idea what happened. You will be the one who says, I knew something like this would come eventually. I did not know the day, but I knew the pattern. And I built my life so this is a storm to walk through, not a wave to drown in. And a final reminder, I am not a financial advisor, and this is not financial advice. This video is for educational and entertainment purposes only. You should always do your own research and make your own decisions.